Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a great day in the markets today. And in today's action, well, unfortunately, the S&P and the QQQs ending red. As a matter of fact, we almost perfectly backtested the gap that was left behind between the Thursday and last Friday session, which does, as I was saying yesterday, leave the door open for the bears to possibly roll things over. Now, we are still having a big battle between the bulls and the bears. The price action is still up for grabs for anyone. We can possibly regain the short-term time frames. However, we can clearly notice, guys, that some things have changed since last Friday's jobs report. Overall today, the reason for the drop, well, you can see that at 10 a.m., the markets started to unwind. Yesterday's price action was very good, continued into the overnight session, and then something happened at 10 a.m., which ties into the exact same narrative that started on Friday, meaning that the economy was getting a bit weaker and weaker as the days do advance. And today's report, as a matter of fact, was ISM services. Now, I'll remind you guys, we've been getting ISM services reports that have been weak for a better part of the last 2 years. Here's the graph, as a matter of fact. You can see that it's been oscillating into the low 50s quite a few times over the course of the last few years. Today's read of 50.1 is weak. Anything below 50 or close to 50 shows that the economy is definitely not as bullish as it was, let's say, prior back in 2019 all the way through 2013 overall. So we know that economic activity in the last 2-3 years has been slower coming out of COVID because of higher rates, because of higher prices overall for the consumer. And however, though, we haven't really been paying attention to this report, even though it's been coming down almost every single month for the last 6 months. We pay attention to it now. Why? Well, of course, because the narrative on Friday was started that the economy was getting a bit weaker as viewed by the non-farm payrolls revisions and the absolute number that came out on the Friday session. Any single macro report moving forward, at least until the Federal Reserve rate cut date in September, is going to add fuel to that narrative and possibly lead to some declines. We have not had many days, guys, in the past 2-3 months overall. I mean, we've gotten bad days for ISM services reports. The one in June was a 49.9, but the market wasn't reacting to it because the narrative simply was not there. As a result, now that the narrative is there for some economic slowdown, well, they will use every single one of these catalysts to push the market to the downside. It did drop after that report, and it continued ever since, which leads me to just an overview, guys, of where we currently stand and why this time is feeling slightly different than the past few months. I'll remind you what the market environment was pre-Friday. Now, we previously had bullish seasonality. As you guys know, July and June are typically very good months for the market. So we had positive seasonality. We were also looking forward to several major earnings reports, especially the big tech names, which did, for the most part, contribute to lifting the indexes. Google had good earnings, Meta, Microsoft contributing to bringing those up. Apple had decent earnings, even though they got sold off on the Friday. The only one being left behind was Amazon. But overall, this earnings season has been quite good. The problem, though, is that we're now kind of winding towards the end of the earnings season, so no more looking forward to any earnings reports to save the market. Tariffs were also paused. Jobs were fairly okay. Inflation was also okay, although in the last 2 months we've had slight upticks. If next week's CPI report comes in once again into a little bit of an uptrend, that's going to be 3 months. That's going to be enough for the media to run with the inflation is in an uptrend in narrative rather than it's just a few key data points here and there, right? And also the Fed saying that the policy was restrictive, but not yet hurting the economy. Since Friday, a lot of that has changed, right? No more bullish seasonality. We know that in the fall, it tends to be quite choppy. Additionally, we have no more earnings reports to provide some lift to the markets. So that is also something that's been removed. Tariffs are no longer paused. August 1st, you had the effective tariff rates coming into play. The jobs narrative right now is definitely not okay. And inflation, as I said, if it comes in hot again, that's 3 months in a row. It's enough to drive a trend. And the last times that that's happened in the market, guys, you may remember what happened. The first time was in the fall of 2023. 3 hotter than expected inflation reports leading into the fall. The markets ran with that narrative into April as well. You guys might remember on the channel, we were covering this. February, March, and April coming in harder than expected. I mean, inflation was on a downtrend, but we just did this, right? So then obviously the narrative starts taking hold. We had another one of those scares from the jobs report back in August, which led to the Japanese carry trade unwind. It's very funny that it's almost been a year to this date since that whole narrative was taking place, but you can clearly tell that they might be able to run run with inflation in that direction if they want to. And now lastly, the Fed will have to pivot. The rate cuts are now over 90% for September, but what will be their stance on the economy? How fast will they pivot? Will they signal any panic? So you can clearly see here that we've shifted from an environment in the last 2 months that's been one of somewhat certainty, at least as much as you could grab. Now, it's currently a cloudy environment. I'm not saying we're going to fall off a cliff, but it's definitely more cloudy than we previously have. As a result, the market conditions have changed. And as a result, as I've been saying on the channel for the past 2 weeks, guys, it might get a little bit bumpy. I am not calling for the absolute destruction of the market, not even close. But is it going to be as easy as it has been in the last 2-3 months rallying off the lows? Maybe not. So now is a good time to slow down the trades. A-plus quality setups only, as we know it could get a little bit bumpy into the fall season. I, for myself, am not doing any more small short duration swing trades such as call debit spreads for 1 to 3 month time horizons, because as we've seen, guys, the market's been very choppy and a bit more volatile since Friday overall. The market, as a matter of fact, is kind of bifurcating between 2 major narratives. As of right now, in the last month, it's basically the AI trade and the hyperscalers versus everything else, guys. It's essentially only the most favorable semiconductor names, only NVIDIA, Broadcom, AMD, and one other one, MPWR, is up. Everybody else is largely down. I mean, TSM could be included in there, even though these guys are not in the S&P 500. Microsoft, Oracle, Palantir performing well, but a lot of the other plays in that technology segment not doing too well. We don't have Apple. We don't have Amazon. We definitely don't have software. I mean, software companies have been coming down a lot. We are still struggling in financials. We definitely don't have the support of the healthcare sector, and even industrials, guys. Industrials, mostly only the plays that are either defense contractors because of the amounts of budgets that they've been getting from the tax bill, and or a lot of your energy infrastructure companies and energy industrial applications for the power ramp for the data center and AI build out. And also you have utilities, a lot of the power utilities also for that same narrative. But everything else, if it's not AI, it's just not doing anything. You can clearly tell this is the 1 month relative performance from the start of the month of July, pretty much to this point in time. So, you know, starting off the bottom, it was the everything rally. And then midway through July, we started noticing some problems with several segments of the market getting left behind. And now, as of the market currently, right, we are still in a very bifurcated market overall, a really divided market. And on top of that, we are coming into a bit of a cloudy environment from all the points that I've previously described. So as I said, time to slow the trades down a little bit. Perfect environment to be selling puts under the market on your favorite companies. Perfect time to also be going shopping for leap call contracts with a very long-term time horizon and a very long-term thesis. But short-term swing trades, they may not be as easy as they have been over the course of the last 3 months, coming off of these lows, the tariff fear lows overall. So that is kind of a preview that I'm looking at here. Maybe for the next couple weeks of trading, I'll be slowing down my trading, especially for the directional bets, and once again be favoring the wheel strategy, right? Selling puts under the market, benefiting from this volatility, being able to write puts substantially below the current market prices, especially on red days like today, but also perfect times, guys, to be adding to your shopping list in terms of going to buy companies that you've been waiting for them to pull back for your long-term portfolios. Every single paycheck, you guys know the drill, 10% minimum of your income should be invested into your long-term future, whether that's via ETFs or whether that is with high-quality companies. Just make sure you do it. Your future self will thank you. So once again, a somewhat long introduction just to give a picture of where the markets currently stand. Now, in terms of today's video, what we're going to do together is a few key things. Number one, we have a few earnings reports to go over. Very fun week this week. Today, we'll be tackling AMD, SuperMicro, and Arista networks. These are some of the biggest ones that we're moving in the after hours. Special shout out to Lemonade, Open Door, and a few more, of course, but we only have so much time in today's video. Tomorrow, so many interesting companies. And overall this week, guys, you're gonna get a lot of very fun growth plays. So I'll be looking for any declines in a lot of these growth plays to possibly seek some levels out to position, and I'll be covering each one of them for you, almost every single one throughout the rest of the week. So we'll do those 3 earnings first, AMD, SuperMicro, and then Arista Networks. After that, we will do our technical analysis rundown of our major market indexes, see how the rotation, or rather lack of rotation, is shaping up on a day like today. Thereafter, we are going to do the same thing, technical analysis rundown on our tech and fan favorites list right here. Derive any possible levels for some swing trades that might be coming up in the next few weeks, but also derive whether or not these companies are good for long-term portfolio buys. At the end of the video, guys, I will take you through the biggest gainers and losers of the day, of which, once again, there were very many. We'll go through some of the most red names on this list. And then, of course, we'll go through some of the most green names on this list and derive whether or not some of them are buying opportunities either way. So it should be a fairly fun video, guys. Let's jump right into it, shall we? SPY down about 0.51. The Q's down about 0.68% today. Overall, the heat map today wasn't very strong at all, guys. Very mixed market. A stark contrast to what we saw yesterday, where we had a big bounce with everything. Now, possibly getting a little bit trapped, right? The title of yesterday's video was, is this bounce going to be for all-time high continuation, or is it just a bull trap? Well, as of now, they filled the gap, trapped everybody at the top. Remains to be seen if we will proceed further to the downside, but the narrative and the catalysts are definitely here for that. So it's once again a situation of you hope for the best because the bulls still control the longer term timeframes, such as the weekly and the monthlies, but you kind of expect the worst because we can go into some extended consolidation on some of those weekly and on some of those monthly timeframes, which would be very healthy consolidation, but consolidation nevertheless. So big tech, very mixed today. Only Amazon pretty much making out alive. And of course, Palantir from their earnings. Financials, not a good day there. Healthcare, a very mixed day as well. And the bottom half of the market, extremely mixed, right? So moving on to the one-day relative, you'll see that this was yesterday's action. And if I refresh it to today, very different, right? Extremely mixed market today. Basic materials, energy, real estate, and cyclicals making it out alive. Everything else to the downside. And sadly, even with yesterday's bounce, we do remain net negative on most of your market segments here. Only communication services and utilities in the green. Everything else to the downside, especially consumer cyclicals down 3.26% overall. And we had several big declines here in cyclicals today, talking about some names like Chewy, some names like Elf Beauty, some of the restaurant companies as well, just coming down. A lot of the apparel companies down as well. It's been a tough time for consumer discretionary names in the past 2 years, and that struggle simply continues at this point. So before we get into more technicals, guys, and break down the S&P and the Qs, let us dive directly into our earnings results. And we're going to start off with the one that everybody wants to see, which is AMD. So Advanced Micro Devices. What an absolute wild roller coaster this has been, from getting called advanced money destroyer to advanced money doubler or duplicator. It's been a very wild ride, guys. We've officially gotten back all of the losses that we've had since last October. And now there's a lot of pressure on this stock because it has rallied from the bottom a tremendous amount. From the tariff fear lows to the top the other day, you're talking about 140%. And I had been saying on the channel that the narrative for the longer term growth prospects for the next 2-3 years of AMD are still intact. But we were seeking to understand whether or not that would translate into this quarterly earnings. As a matter of fact, the company right now is down 4% in the after hours. However, they did have pretty decent earnings, but they missed on a few key metrics. And we know how picky the market has been with earnings recently, especially this earnings quarter, and AMD unfortunately suffering to the downside because it missed several key metrics. There are obviously some justifications to that, but let's move into it, shall we? So in terms of the headline numbers, guys, the earnings per share came in at 48 cents versus the 49 cents, which was expected. So they missed on EPS, but a very nice revenue beat here, 7.69 versus 7.42. Some of the easy numbers here, revenue was up 32% year over year. Starting to really ramp that data center segment. Speaking about that data center segment, data center AI revenue 14% year over year, which is very solid. Operating margins here was the negative point. Now, a lot of that has to do with the export restrictions that were placed on them from the administration earlier on in the June session, right, in the June month, whereby they couldn't export some of their models towards China. So they took an impairment charge, essentially, the same thing that happened to NVIDIA. Now, obviously, since we know that AMD has been able to apply for some licenses, just like NVIDIA, and the exports to China will probably be resuming in the next few weeks. But still, that charge is there for the current quarter. That is also why you have a negative earnings before interest and taxes, down a lot, 29% year over year because of that impairment charge. And then earnings per share down 30% year over year. Same concept, guys, because of those impairment charges to the tune of about $800 million. NVIDIA was $5 billion, I'll remind you. Let's move into the article, shall we? AMD reports weaker than expected earnings even as revenue tops estimates. So, for the current quarter, AMD expects sales of $8.7 billion. Here's your guidance. Plus or minus 300. That is versus the expectations of 8.3. So still, even with the plus or minus 300 coming in above. So it wasn't truly a bad quarter for AMD, but those operating margins and that miss on EPS is enough to kind of take the shine off the stock temporarily and send it into a bit of consolidation. Net income reported was $872 million, which does translate to okay margins for AMD. Talking about net margins here of roughly, I don't even have it. I didn't put it down there. My bad, guys. It translates to margins of about 11.3%. Oh, never mind. It's right there. My bad. Which is better than Q1, but still not the expansion in margin that you were expecting because, once again, of those impairment charges. You would expect that a company that has a lot of pricing power recently, I'll remind you, they just increased their prices by 70%, which is very good, from $15,000 to $25,000 for their data center chips. But a lot of those juicy margins will not be realized until next quarter. And with the scale and speed at which they are ramping their data center offerings, you really want to see all this EPS growth, all this revenue growth translate into better bottom line margins, but also operating margins as well. And unfortunately, this was not the quarter for AMD. I think Q3 and Q4 will be much better looks for the company in terms of margin aspects. AMD is the second biggest maker of GPUs for AI behind NVIDIA, which is the vast majority of the market. But big AI customers such as Meta and OpenAI are increasingly looking to AMD to provide an alternative to NVIDIA's pricey chips, especially for inference or when AI models are deployed to the public. During the quarter, AMD announced new AI chips called the Instinct MI400 that are expected to hit the market next year. OpenAI CEO Sam Altman committed to using AMD's newest GPUs. Here's what Lisa Su had to say, the CEO. AI business revenue declined year over year as U.S. export restrictions effectively eliminated MI308 sales to China. Same thing like NVIDIA, right? And we began transitioning to our next generation. The MI308, the China chip, was previously barred for export to China in April, which the company said cost it $800 million in the June quarter. The company said in July that it expected shipments to resume after the Trump administration signaled that it would approve the waivers. AMD said its outlook does not include any revenue from its China-focused AI chip. So as a result, this guidance, which was better than expected, does not include the resumption of those shipments. So if it would probably be even better. So please keep that in mind. 7 of the top 10 model builders and AI companies use Instinct, talking about AMD's data center GPU offerings. AMD's adjusted gross margin during the quarter was 43%. It's okay, guys, but still, because of those charges and because of the extra costs of ramping, it is not as good as it should be. Definitely not as good as NVIDIA's gross margins, which are high 70% range. The company said it would have been 54% if not for the export control costs. So you can see a clear hit here in gross margins. AMD's main business, aside from GPUs, is making CPUs, which compete with Intel to power more traditional servers. Both are reported in the company's data center segment, which had a $3.2 billion in revenue, which was up 14%. So they're including the server-side CPUs in their data center offering in terms of the revenue numbers. Now, one segment of AMD that was very weak over the past 2 years was definitely client and gaming. And I'm happy to report, guys, that the turnaround might just be there for that segment. 69% year over year, up to $3.6 billion. We really needed this one, guys. This is all their CPUs for laptops and desktops and the GPUs for gaming purposes for individual PCs. Gaming revenue by itself was up 73% year over year to $1.1 billion. That is very good, guys. I'll remind you, last quarter, the gaming revenue segment was down 30% year over year. So we can see a nice little uptick here. And that was versus the street account, 1.1 billion, was versus the Wall Street estimates here of only 784 million. So they beat that a lot, which was due to increased demand for custom chips for game consoles and gaming GPUs. So I know I just threw a lot of numbers at you, but I'm going to explain what is exactly happening here for AMD. Here you can see the yearly progression of their different revenue streams. So in blue, you have the data center segment, which is ramping very strong. In terms of the orange segment, that is client revenue, right? The client revenue, which is basically your CPUs and things of that nature for individual customers. right? You can see that how much it's been struggling here, 2021, 22, 23. It started coming back in 24, but now clearly ramping in 2025. So that is now good. The gaming revenue was a big pain point for the company, especially last year. That is the purple bars right there. You can see that it was very high in 21, 22, 23. We started falling off. 24 was it was a very big drawdown there. And now 2025, the gaming revenue is starting to curl up a little bit. And then you have a smaller segment of the business, at least for now it is, which is the embedded revenue. Embedded is, let's say you're a company, right? And you order 1,000 different computers. AMD is going to put some very, well, no, I wouldn't say rudimentary, but some very basic cards and GPUs in those office computers and also for industrial applications. That's the whole embedded segment. Not a very sexy segment, of course, but is one that drives about $3.5 billion of revenue for the company per year. This is on the annual basis, but if you look at the quarterly, it gets a little bit messy. You can clearly see the data center offerings have been ramping nicely, but you can see this quarter's fall off, guys, because of those impairment charges related to the sales from China. If they had that $800 million, guys, this would be about $4 billion. So it would be the highest bar on the chart, but we can clearly see there was a drop off there. The client revenue, the orange bars, they've been performing well. The gaming revenue, the purple bars right there, that's why you can see a 79% year-over-year gain versus Q2 of last year. So we have now bottomed. If you look at this on a granular basis for the gaming, which is the purple bars, we are rounding the corner right now. Embedded, not quite back just yet. So we can see a couple segments of the business are performing well, but we have some choppiness here in data centers because of the impairment charges, $800 million. But two other lines of business, namely gaming and embedded segments, just have not come back yet, although the client revenue one, more associated with CPUs, is doing quite well, right? So very mixed bag for AMD overall. They were not bad earnings if I do consider all of those things combined. Here we can see, right, the 32% year over year. The earnings slides just don't give you what we're looking for here, right? In terms of the total breakdown, which is why I gave a very fancy chart and broke it down by year, by quarter, just so you guys understand the cycle that AMD is in right now. Here's the gross margin hit, obviously, right, from 49% down to 40 and non-GAAP 53 down to 43. That is the 10% charge because of the $800 million inventory and related charges associated with the U.S. export controls. We're not going to spend too much time on that. We've talked about it a lot. Operating income as a result of those charges went from positive to negative, and Wall Street did not like seeing that, of course. But the good thing is that that is now behind us, right? We can look forward to the future. GAAP EPS, sadly, below last year and below the estimate, which once again are those impairment charges. We already went over the P&L structure. There's no secret there. Operating margins were down, sadly, as a result of those same charges again. And if we just take a look at the segment results here, right? Just going to show you the segment results. Revenue for data centers was good, 14% over year. But there you go. The operating loss, that is what Wall Street did not want to see, contributes to the loss again, because once again, the inventory expenses overall, and just due to the China segment, right? Client and gaming, this is a bright point for them. Revenue was up 69% year over year, but look at the operating margins. They are coming back. That was very good. And embedded, still struggling though. Revenue was down and operating margins were down as well. So the highlight this quarter is that client and gaming is actually coming back. The data centers had those charges, so unfortunately AMD's share price is going to come down as a result of it, but it was not overall a bad quarter for the business. I still do believe that the best quarters for AMD are still ahead of us. Those are the quarters where they will really be able to use that pricing power, the pricing power that we've just gotten from these price increases here and large contracts with the other hyperscalers. We're going to be able to drive a lot of margins to the bottom line, more free cash flow, more EPS, and of course, the revenue is going to just follow the normal curve that it should be following so far. In terms of margins, EPS, and free cash flow, I truly do believe that Q3 and Q4 will be much better quarters for AMD into the future. But this one, the entire focus is going to be around that impairment charge, the margins that are not expanding as quickly as people would have liked to see, but revenue, the important part, is expanding at exactly the pace that we want to see. As a result, the thesis is still well alive for AMD, and I will be looking for any discounts here on the share price to possibly reposition for that Q3 and for that Q4 ramp, and even into 2026. All the things that I buy for AMD, I am definitely holding into next year. That being said, at the current price, is it a good buy? Around, well, I did it around 175, where they initially came out after earnings. They're about 5% lower than that, but I mean, the numbers are going to be relatively similar here. At 175, is it a good deal? 45 forward price to earnings, which is not bad because they are growing earnings at 30% per year. It gives them a forward PEG ratio of 1.51. Now at 166 in the after hours, it's even cheaper. This, in my opinion, from here all the way through 150, 140 area is an accumulation zone if you do share the same thesis that AMD will be expanding margins, revenue, and EPS very nicely over the next 2 to 3 years. The forward price to sales is about an 8.5 right now, with a bit of a decline right now, which is also not so bad considering that the industry standard price to sales right now for a lot of these other companies like Broadcom and NVIDIA is like a 14, 15, right? So they are undervalued, whether you look at price to sales or price to earnings growth. They are one of the more undervalued companies in the entire segment right now. So I am a big believer that AMD is still a very good risk to reward trade, especially if you're planning to keep the shares into 2026 and 2027. For sure, the fastest part of the rally is now behind us, but I do still believe that there is probably another 2x over the next 1.5 years as they ramp. The valuation definitely would support that expansion of the business to that effect. My price target for AMD come 2027, at some point in 2027, is almost $300, so keep that in mind. That is everything I had for you guys for AMD earnings. Now let's jump into company number 2, which is going to be another interesting one, Arista Networks. And we rarely ever talk about this one on the channel, but it's such a strong company. And if you don't know what they do, guys, they essentially sell networking equipment for data centers, but they also service that networking equipment. So they have product sales and they have service sales as well. The company is obviously very well positioned to benefit from the AI narrative and the data center ramp narrative right now. A lot of my Discord members made a decent amount of money buying these lows when the company was undervalued, but now at the current price with a 14% pop in the after hours, is this company still a good buy? Well, let's have a look, shall we? In terms of their earnings that they reported, they absolutely destroyed it, guys. 12% beat on EPS and a nice 4.6% beat on revenue. All in all, a tremendous quarter from Arista Networks. Let's take a look at some of the easy numbers real quick. Revenue up 30% year over year. Very solid. Adjusted EPS, this was down, but this chart is using GAAP EPS. If you actually take a look at the non-GAAP EPS, there was no misses here whatsoever in terms of year over year. They're actually decently up on a year over year comparison. Very stable EPS growth for the company overall, and very stable revenue growth expansion as well for the company. Coming back to the easy numbers, net income, the profits here, 34% year over year gain in net income, which is fantastic. That gives them net margins, guys, of 41.9%. Absolutely stunning profit margins. That is even better than the 40.7% net margins reported in Q1. That being said, operating income was also up a cool 41% year over year. And let's dive into some of the highlights of Arista Networks' earnings, right? So moving on forward, demand for the company's Ethernet switches and routers, which are widely deployed in data centers, has surged as enterprises accelerate AI-related spending. Arista has projected third quarter revenue of about $2.25 billion, and that is in comparison with the analyst estimates of $2.11. So once again, smashing the estimate target. Moreover, US-based firms such as Arista are widely expected to benefit the country's tariff policies, as it may help them win new contracts from hyperscale clients and boost market share. Arista's customer base includes leading cloud service providers, with Microsoft and Meta platforms accounting for almost 20 and 15% of total revenue, respectively. So very large clients for the business overall. Looking quite good in terms of the double earnings beat right there. If we also have a look at some more earnings numbers, or rather another chart that I have for you guys, look at the free cash flow margins. This company makes so much money in terms of net income. They bring a lot of money to the bottom line, and they don't spend that much money as well on CapEx, which makes it one of the better free cash flow margin companies in the entire market. Here are some of the more infamous technology companies which are ranked, and you can see Arista Networks right here in the middle, 37% free cash flow margins, which is it's with some of the best players right now in the current market. Phenomenal company overall. If you take a look at more of their earnings, Arista, here's what the CEO had to say. Arista is well positioned in data-driven AI networking from client to cloud. Our customers are decisively standardizing on our best-of-breed platform to bring transformational innovation and impact to their technology endeavors. So a very well-written sentence essentially saying, yeah, we have a tremendous amount of business, we have a lot of recurring customers, and they're not going anywhere. Moving on further, non-GAAP operating income crossed $1 billion for the first time at Arista, highlighting the strength of our business model and the momentum of customer demand across our portfolio. Our ability to scale efficiently while maintaining financial discipline continues to deliver value for our shareholders, basically saying, as we scale more and more revenue, our expense profile is well within control, and as a result, we can deliver to you, the shareholder, better and better margins and better free cash flow. This is also a company with some of the best return on some of the metrics that I don't mention that much, guys, but it's in terms of when the company gets $1 from its revenues itself, or when it gets $1 from either raising capital in the public markets or the private debt markets, how well is the company able to utilize every dollar that it generates from its own business or from raising capital, right? And those metrics are basically return on invested capital, 54%. Guys, this is insane. You usually do not see companies with a return on invested capital metric of 54, and they're below return on capital employed, 30.61, which is some of the highest metrics that you will ever see. Arista Networks, an extremely solid company, guys. Nothing bad to say. They have an extremely strong balance sheet as well. I mean, we've mentioned the profit margins a couple times so far, but just to show you, they have no debt. It's a free cash flow monster, and they have a ton of money on the balance sheet. This balance sheet is an A++ from me, and as we were currently seeing before, it's a very consistent business model as well. You don't have that much cyclicality, all things considered, right? The EPS is very smooth up and to the right, and revenue is very smooth up and to the right, which gives them very good growth numbers for the next few years. Revenue almost growing at 10% per year for the next 3 years, and EPS growing at mid-double-digit numbers for the next few years as well. And they do a decent amount of buybacks as well. So with all these highlights and the fact that it's an extremely high quality company, is it still a buy at 135? Well, let's have a look here, right? Forward price to earnings at 130 is about a 49. They have an EPS growth rate of 16.5, but still, that gives them a peg of 3. Sadly, guys, it used to be 1.5 down here, which is why it was such a screaming buy in my opinion. And as a result, right now, it is fairly valued and kind of overvalued, especially if you follow some of these guru focus metrics as well, which is one of my favorite websites here. But even I do also deem this company to be fairly overvalued right now. It's very rich, right? Price to sales right now at 18.5 also is not the best metric. And despite the amount of free cash flow that they bring in, the market cap has just ran too far. When it was down here, 70, 80, 85 bucks, free cash flow yield was like a 4.5. The PEG ratio was a 1.5. It was a screaming buy. But unfortunately here at 135, guys, I can't really position at the top end of the valuation. It's been very nice if you are a holder of the stock. I don't see any reason to sell, but starting a position up here, guys, maybe not the best risk to reward profile for this company. But that being said, it's one of my favorite companies that I never talk about. So congratulations if you are a Arista Network shareholder. I would be very happy with this earnings report overall. That's everything we had for this company. And now, coming into company number 3, somewhat the opposite, not a very consistent company, one that's been marred with a lot of problems. And of course, that is SMCI, SuperMicro Computer. Now, you may remember this company as one of the largest gainers both in 2023 and especially in 2024. But since then, they've been plagued by a few things. Number one, declining growth rates overall for the business. And number two, of course, well, we got to talk about how many times they've been accused of fraudulent financial statements and possibly being delisted by the NASDAQ a few times. They were able to delay that. They were able to change auditors and now report properly, but the share price definitely has suffered in the interim. So what we're going to establish right here is even after SMCI has come down from the top to the bottom there, 83%, it's now recovered a little bit from that. Right now, the stock is down 16% in the after hours. Overreaction or justified? Is this stock a buy right now? Have they gone through their problems? Or are they still facing a few problems? Let's get into it, shall we? Moving into the earnings profile right here, the stock actually missed on EPS by almost 8% and a miss on revenue by 3.73. Overall, though, guys, I'll show you that SMCI's numbers were not bad at a first glance, but there are some problems with this company. Some of the easy numbers real quick. Revenue was up 8% year over year. This used to be a company, guys, that was growing revenue triple digits. It's now down to single digits, only 8% growth year over year. EPS, big miss here, not only on the headline number, but year over year, decline of 34%. Gross margins also coming down 7% year over year of a decline in gross margins, whether you measure on GAAP or non-GAAP as well. Those are just some of the few problems affecting SMCI. Let's move into the article, shall we? SuperMicro shares plunge 15% on weak results and disappointing guidance. Let's move into it, shall we? SuperMicro's revenue increased 7.5% during the quarter, which we already saw. For the current quarter, here's the guidance. SuperMicro called for 40 cents to 52 cents in EPS. The midpoint is 46. The analysts' expectations, 59, missing the guidance benchmark by a lot. What about revenue, though? Revenue was slated to be, their guidance is 6 to 7 billion. The midpoint is 6.5. Analysts were looking for 6.6, so barely missing the estimate there, but still double miss on guidance. For the 2026 fiscal year, SMCI sees at least $33 billion in revenue, which is above the consensus of 29.94, so coming in a bit light for next quarter, but overall for the full year, they will be surpassing at least the revenue expectations. They did not provide any guidance for EPS or margins, which is what the street is concerned about, and I'll show you why in just a few moments. SuperMicro saw surging demand starting in 2023 for its data center servers packed with NVIDIA chips for handling artificial intelligence models and workloads. Growth has since slowed. If you want to know what SMCI does, all they literally do is manufacture server racks. That's literally it, right? Not the biggest moat, not the biggest competitive advantage. They have a lot of other competitors such as IBM, such as Dell, and a few other niche players as well. It's just a server rack. When you want to shove, 10, 12 NVIDIA Blackwell units in a data center in one server rack, it's literally just a rack, right? You just put them in there and SMCI just builds the server rack. They previously used to be air-cooled, but they've spent a ton of money in the past year and a half pivoting to a liquid cooling solution. As of right now, they are seeking to obtain about 30% of the entire liquid cooling market share in 2025. Let's move into some of the earnings highlights, and then I'll show you some of the problems. So they introduced their digital liquid cooling 2 solution, lowering 40% power and water consumption and significantly lowering the noise to about 50 decibels. They unveiled a broad portfolio of more than 30 solutions designed for new NVIDIA and AMD architectures, so that's good. They are targeting 30% of the global new deployments for those server racks, especially in the liquid cooled market. And in terms of manufacturing, since there is a lot of demand still, which is why they're posting good revenue numbers, they're expanding capacity, adding a third campus in Silicon Valley, in Mexico, Taiwan, and the Netherlands as well. But it's costing them a lot of money, guys, and their margins are suffering, which brings me into some of the problems for the company. Let's move into it, shall we? So you can see here that they have a few different lines of business. Number one, server and storage systems, basically the server racks. That part of the business has been rapidly scaling for the last 2 years. Subsystems and accessories that go along with those, those server racks. Well, that unfortunately, guys, as you can see, is not doing too well, right? So apparently they can sell a lot of servers, but not so much accessories. Remaining performance obligations. How much money do they have in the pipeline at any given time? You would expect it to be a lot, but they're only reporting a fraction of the amount of business that they deliver on a yearly basis. That also doesn't give Wall Street the best optimism about the company, about how much true demand they can actually secure, and can they hold on to those market share claims that they're trying to achieve, right? Here is the problem. The green line is gross profit margins, the red line is operating margins, and the yellow line is net profit margins. When the company was scaling rapidly, because it was generating so much revenue, a lot of people were anticipating that this was going to translate to better and better margins over time. As a matter of fact, it's been quite the opposite. The liquid cooling solutions have cost them a lot of money, and you can see net margins from the peak here or gross margins from the peak in 2023, they're now down from 18 to 11, and it's not much better this quarter either. Operating margins down from 10.7 to 6.1, and net margins down from 9 all the way down to about 6%. So we have a case of margin erosion. The company does not have operating leverage, meaning that when it's scaling its revenues, its margins are not getting any better. And that's a problem, especially since their growth rate for revenue is slowing down. This infrastructure ramp will not last forever, probably the next 2 years. If they are not able to deliver very good margins when the revenue is scaling so rapidly, it raises the concern, right? What's going to happen when that infrastructure build out is done? So keep that in mind as well. If you take a look more at some of the margin problems here, you can see that especially in this 3-month comparison from 2025 to 2024, same Q2 of last year, well, their revenue is only up 7.5. What about their operating expenses? R&D, that was up 43%. Their sales and marketing, up 15.6%. Now, they did pull back here on G&A, but still, total operating expenses for a 7.5% gain in revenue, operating expenses, guys, up 22.7%. That is what's causing this erosion. Their expense profile is just going up too fast, even in spite of how fast they're scaling the revenues. Those are the problems that SMCI is facing right now currently, and there is still this lingering sentiment around the stock because of what happened surrounding the reporting of their financial statements. Many people do not believe the numbers. Look at this free cash flow crush. They spent so much money on R&D, but also just outlaying the free cash flow for the liquid cooling solutions. They burned so much free cash flow, guys, in the last few years. Their debt profile has crept up as well. They have okay cash on the balance sheet right now, but the balance sheet is definitely not the best as well. And when we take a look at the ramp in EPS, sadly, the company is not giving guidance further than 2027, right? Usually we get all the way until 2028. In terms of possible projections for growth rates, you can see here that EPS is okay, and revenue growth is also a very good aspect for the company, but it is definitely slowing down in relation to prior years. You really need to see the company start to control margins quickly if you want to see some sustained growth into this stock. I'm a big fan of the thesis that, rising tides lift all ships. The AI trade, the infrastructure trade can lead to very decent gains. From the tariff lows, we've had those gains. It doesn't look like much, but from the top of last week, 120% off the bottom. So now that the company is down 16% from those highs and possibly coming back into our support range right here, which is 49 down to roughly 41, is the company a possible buy for further continuation as the infrastructure narrative moves on into the next 6, 12, 18 months? Well, let's look at some numbers, shall we? At $48, what is their price to earnings? It's a forward price earnings of 17.45. Not bad, but why are they not in the mid-20s? Why are they not allowed to trade in the mid-30s just yet? Because they're very inconsistent, and we cannot derive a target margin rates or rather target margin rates, plural, gross, operating, and net for the company. It trades at a very cheap PEG ratio, extremely cheap, 0.61, because we cannot guarantee how fast the revenue is going to continue to ramp, and will the company be able to drive bottom line margins and free cash flow to shareholders? That's why it is still trading so cheap and why it has not exploded to the upside despite all of the short interest on the company as well. Price to sales of 1. In semiconductors, guys, finding a price to sales ratio of 1 is almost unheard of. By large and by far, this is one of the cheapest semiconductor companies. Even though they don't even do semiconductors, they get lumped up in that same area, right? Because it's just semiconductor equipment. Overall, this is one of the cheapest companies that you can find, but because of the reasons that we previously established, we understand why. It's a question of consistency. Can they keep delivering at a consistent pace in terms of revenue expansion for the next 2 years? But thereafter, what happens to them, right? Are they able to get the margins back? Are they able to get the free cash flow back? We're not sure. This one remains a lottery play for me. If I do position, I still think there is an opportunity here for SMCI to see some gains just based off the fact that the valuation is still so low, and we are probably going to see a lot of demand still for their services over the next 6, 12, 18 months. But that is the end of my thesis. So I still do believe it's a okay buy down here, but small. It should be a lottery position. We should not be overcommitting to this trade, but we can see some gains in the future, but it might just be a little bit bumpy. That is my analysis for SMCI. Hopefully you guys enjoyed that. And with that, that wraps up our earnings for today. Let's jump into some of the charts, shall we? And we're going to start it off as we usually do with the good old S&P 500. So of course, a red today, but the action here is more concerning on the short-term time frames, right? We knew that yesterday was a very nice bounce. they actually filled the gap perfectly from the Friday drop. And now, guys, it's looking like a bit of an engulfing move for the bears. If the bulls are not able to turn this around by tomorrow, you could be looking to revisit some of the lows. If that does happen, your short-term daily downtrend is definitely underway. And if you crack this low right here, 619, guys, I will remind you that that will officially be your first daily downtrend in a very long time. The first time in the last 3 months, roughly, we have clearly lost a 12 EMA. It is acting as resistance right now. And if, as I said, you flush, you are going into further daily downtrend consolidation, further weekly consolidation, but overall, very healthy consolidation. Let me just put this off to the side so it's not distracting. And at that point, guys, you will just be looking for a back test here. 613 down to roughly 597, your prior all-time high range, your weekly 12 and possible 26. And that will be a top to bottom, quote unquote, correction of the S&P of about 4 to roughly 6%, which is standard. I'll remind you, usually you do get a few of those per year. Very rarely does it translate into anything more, such as the tariff sell-off. At the most, it can turn into a 10. There's a few in 2024, although you guys may not remember them just yet. There was actually 3 of them where the S&P went down 5% plus last year. Is this the start of the next one? Possibly, but keep in mind the bulls still are in control. We have not lost this low just yet. They still do have a chance to recapture the price action, but it'll be very important for them to do so in the next 2-3 days of trading, because if not, you are clearly going a bit lower, and then we will kind of take it from there. I still do believe this is the perfect market. Rather than trying to predict where the price is going to go, we have to pivot our strategies. Short-term directional bets, especially long bets, right, are maybe not the best way of doing things. I'm a big fan now of selling options, especially with the increases in volatility as we move lower into our support ranges. The bulls are still in control. Anything above 591, looking for a clean, higher low for possible further trend continuation. But if seasonality is choppy in the fall, you may just devolve into some form of a tightening range. Moving on to the QQQs, pretty much the same analysis here, guys, right? You got to pay special attention to the lows that were established on Friday, 551 to be precise. In the event you unwind this, which would not be surprising, perfect fill of the gap, right, on the Friday session. If you unwind with unfavorable price action, you are coming right back down here, probably into the support range. Prior resistance should be newfound support. You have the 12 and the 26 here on the weekly timeframes. Would just be a very healthy weekly higher low. Keep that in mind. Anything above 522, weekly higher low, maybe for some further trend continuation, but you would also not be surprised if seasonality is choppy and the news cycle is choppy as well. In terms of the macro releases, you might just get a bit of a consolidation range at the highs before moving into Q3 and Q4. So still a good environment to sell some puts on your favorite big tech names or other tech names in the market. Moving into financials right now, financials somewhat unclear. We had a daily downtrend, nice engulfing move by the bulls, and then since has been unwound. So your new lows are right here, 5104. With this engulfing move, it definitely favors the bears for the lower high into the lower low rollover, which could be testing some of your previous weekly levels here established in the month of July, around the 26 EMA on the weekly. Very wide range here. The volatility is currently expanding, of course, and you do see that in the financials landscape. The clearest time frame of them all, guys, in my opinion, though, you're just looking for a monthly higher low, right? So at the worst extent, you might come back down here to 49.48, but any retracement is going to be healthy retracement, in my humble opinion. My favorite plays in financials right now, Visa and MasterCard. They had fantastic earnings, reiterated guidance for the end of the year, said that the consumer was still healthy and that their network effects were going to carry them into having another good year for these corporations. Visa, 330, 320 for me, especially after it's been consolidating here a number of times throughout this year, could definitely be a buy. And MasterCard, in its own respect, that would be about 540 down to about 520. So keep those two companies in mind. Probably my two favorite companies in financials to go shopping for right now. Into healthcare right now, healthcare. Pay special attention, guys, to these lows, right? Still just doing a whole lot of nothing. It's been very, very bumpy, especially for earnings season right now. 130. Pay attention to this line, guys. You lose that, it is another weekly downtrend, and the monthly lows have unfortunately not been found just yet. But the monthly time frame has all the keys right now, guys. Clear support. So the bulls still do have a little bit of wiggle room here down to the low 120s. And we're also below some of our historical moving averages right here. Well below the 50 EMA. Well, not well below, but you can clearly see that we are below, right? We have only tested it a few times, and usually we have made it back above the 50 rapidly, usually within the first couple of weeks. But now we've been hovering here for about the better part of the last 2 months. So I do still think healthcare is a phenomenal trade right now. It is definitely the most undervalued sector in the entire market. But when is the rally going to be? That is what we don't know. So as a result, it is an accumulation period. Maybe not the best for some quick short-term swing trades to the upside, but definitely an accumulation range for longer-term plays, either leap call options or just shares. I'm playing the ETF overall, as I will not play individual healthcare names. Moving on to semiconductors right now. Semiconductors also down about 1.06% and another 0.67 in the after hours because of AMD. Pay attention here on SMH. 279, flushed lows of Friday, daily downtrend, and a clear loss of the 12 EMA. Two things which have not happened in the last 3 months. If you do consolidate, going into weekly consolidation, which might bring you into this area of confluence, prior highs, and the 12 EMA, which is this yellow line, 275. Now, the SMH is more heavily weighted in the more favored companies like NVIDIA, Broadcom, and AMD. However, if you want one with a bit more equal weighting, although those are still the top holdings, it's a bit more even, right? The SOX, right? The SOX not looking too bad, and the setup is a bit more clean in my humble opinion. Talking about a pullback, 236 down to 215, just looking for a weekly higher low for further trend continuation, which is why I am playing a lot of short puts here on SOXL. I'm looking for the pullbacks, 20 or slightly under 20. I would be a big fan of picking up some shares, and if I don't pick them up, I'll be farming a great amount of premium on them. Moving on to the IWM Russell right now. So IWM responding well today, 0.51% to the upside. Not too bad of a day for them, but we know the short-term bears are in control. Maybe just looking for a lower high and then possibly revisit right now. So this is going to be a very complicated trade, guys, because we don't know the pace of rate cuts. We know that they're probably coming in September, but rate cuts are the single biggest determining factor for the expansion of the Russell. In my opinion, if the SPY and the QQQs are somewhat muted with a downward bias, well, you're not going to get the expansion of the Russell, right? Even though yields are pricing in that rate cut, we may just revisit the lower bound of support, which is 216 to 208. Still a very choppy trade, but maybe into index consolidation. Maybe I wouldn't mind positioning in this sector, but it would have to once again be for a longer dated thesis going into 2026 and early 2027. So as a result, it would either have to be shares or leap call options for me on this index. Not so much very quick and rapid swing trades throughout this very choppy seasonal period of the markets overall. That's pretty much it for your index rundown. Taking a look at the VIX. The VIX is basically doing a whole lot of nothing, although we did have a slight little uptick today. You know, I think we might just stay muted here until CPI. CPI is the next big macro data point over the course of the next 2 weeks. It's early next week, as a matter of fact. If it comes in higher than expected and the markets drop as a result because it adds fuel to the narrative that we have right now, well, then you probably get your next leg of expansion onto the VIX. Are we going to head back to 30? Probably not. I don't think there's enough uncertainty in the markets to warrant that right now, but pay attention. That might just be the next volatility expansion catalyst. As of right now, we may stay muted, but you guys know the drill. As long as we stay somewhat elevated on the VIX, it's a great time to be selling puts in the market on your favorite companies well below the current market prices and collect that juicy premium. In terms of your yields, take a look at the 10-year yield. Well, today was another decent day, right? Not rallying that much, and we are looking for the weekly downtrend into possible monthly downtrend formation for the 10-year and on the 20-year yield as well. You were looking for the breakdown here below about 4.75. If you can get that, it's going to be looking good into the month of September. Finally, the bond traders are getting behind the rate cuts that might be coming, because we know what happened last time that Powell cut rates. The long-term yields went straight up. That was bond traders calling the bluff, saying, you're not cutting rates for the right reason. The economy is not struggling right now. You are just doing accommodative rate cuts. But as a result, we will keep the risk premiums high in case you are wrong. As a result, right now, though, if rates start coming down because the economy is struggling, the labor market is struggling, well, then they will get behind that. And then you will see a come down here on the 10 and 20-year yields, which means that the bond trade is still good, but it still will be moving a little bit slow. This one might just come alive in the second, well, Q4 and into maybe 2026 as well. And that's pretty much everything for your overall index rundown. If you take a look at gold right here, Gold is a trade, guys, that has many faces. Sometimes it acts as an inflation trade. Sometimes it acts as an uncertainty hedge. In the recent few days since Friday, it has definitely been the uncertainty hedge, right? So what you're looking at right now, guys, is we had a daily uptrend, engulfing move by the bears, challenging some of these lows. If the jobs would have been okay, we probably would have flushed and more money would have just rotated into equities and it would have still been risk on. But now that we have a bit of a risk off narrative, gold is benefiting. Now, we have a very nice retracement here on the fibs over a 618, which gives the bulls a great chance of doing one of two things. Either breaking above this resistance level, which is pretty much 3,400 down to 3,360 for the good old breakout, retest and run trade. That could be interesting. Or if we pull back from here and get rejected from here and try to establish a higher low, I might be looking to position, guys, with the stop below there and go for the expansion during a bit of choppy seasonality for equities. And with the uncertainty narrative that we have ahead of us, gold might just be one that does catch a bid. And lastly, Bitcoin down about 0.85 today. They were down almost 1.5 at one point today. Overall, though, guys, the trend is very clear. Daily downtrend looking for a lower high for possible lower low. Overhead resistance stays planted at around the 116. And right now, we are just in very pure and simple weekly consolidation. Nothing more than that, right? The support range below us is 108 down to 100, the previous big area of all-time high resistance. Now will be current support for the bulls, and I will be possibly looking to position in the event that we do revisit these levels, position for Q4 and into 2026 as well. When we do get through this short-term narrative, I don't think we're going into a recession, guys. I don't think the economy is going to fall off a cliff, but you have all the ingredients right now to kind of take some froth out of the markets and go into consolidation until we get the clearly defined Fed cut path, essentially, and until those tax cuts for the consumer really start hitting those paychecks to where people start to feel a bit more wealthy than before. That, in my opinion, is when you're going to regain the risk on sentiment, but it might just, we'll see. It can happen tomorrow, right? But as I will say, guys, you don't try to predict. You just, with all the information you have available, you set a timeline. You hope for the best because the bulls control all the medium-term trends on the SPY, the Qs, Bitcoin as well. But you can expect the worst, right? So that is kind of how we have to position as traders, especially. Moving on to our big tech names, shall we? So first and foremost, as usual, we're going to talk about Apple. So Apple, of course, unwinding this very nice daily uptrend that we had. We have the big engulfing move as a result of earnings, but the clearest time frame, in my opinion, remains the weekly. We have a nice support down here, 200 down to about 192. This is going to be a nice accumulation range, guys. If the indexes are slightly sluggish moving into the next few weeks, I think this is a good one for longer term swing trades, meaning leap call options for a possible reversal pattern here into late Q3, into Q4 as well, and into 2026. But short-term trading might just be a little bit choppy, right? So if you put too little time on some of those call options, they may not pay out the way that you would expect them to, especially in a heightened VIX environment. So I'm a big fan of either shares or leap call options into this support range, or selling put options, which is what I've been doing on Apple on the big red days. I'm selling puts well below the market and just collecting some very juicy premiums. We covered their earnings last week. Seems as though Apple is rounding the bend in terms of their revenue growth rate problems. And I do believe that the iPhone 17 and other products Apple will be releasing during the next 2 quarters should be fairly well received by the markets and could continue to contribute to that acceleration of the revenue growth path. Moving on to AMD right now, we just covered their earnings, but as I've been saying, guys, in the event that we pull back down to 150, I will be accumulating. But since the markets will be chopping, not trying to go for any short-term scalps and swing trades back to the highs, no, I'll be accumulating more shares and possibly some leap call options. And we would just be looking for a weekly higher low. So as of right now, 164 is here. That is a daily downtrend, the first of its kind in a long time. And we will also be losing the 12 EMA, something that we have not lost in a while. So keep that in mind. The consolidation could continue. And if worse comes to worse, we might just be heading back down there, 150 all the way down to 135. That is the big range. I'm not saying it's going to go down to 135, but the EMAs are there. And that is where your next price support would probably be found. And the current resistance range still stays put at 184 to 170. Sadly, they didn't have the juice to break through and use it as support. So now we might just need to reprice a little bit lower, but we covered their earnings. Fantastic opportunity in the event we do move lower. Onto Amazon right now. Amazon actually bucking the trend, 0.99 to the upside. Amazon was almost up 2% at one point today. But the indexes are weak, guys. We've done a couple things, right? Since earnings, we, number one, lost the daily uptrend, lost all of your short-term EMAs on the daily, but also we've lost the support range, right? This is now resistance, 227 to 220. So in the event we start moving higher, wouldn't be surprised if the first touch is a rejection. Then it'll be up to the bulls to confirm, can they go for a daily uptrend, or will we just kind of roll over, right? In the event that we roll over, because I'm pretty sure that's the scenario that people are worried about, well, I'll be looking down here, low 200s to sell some put options, but also to accumulate some shares, and that'll also be a criteria for me to go shopping for more leap call options. I think Amazon into the end of the year will have a very good Q4, and especially 2026 should be an extremely juicy year for Amazon. So I'll be looking to load up all that I can in preparation for those longer dated swing trades, right? So you see the focus that I'm putting on things right now. I'm looking 1 or 2 quarters ahead, and I'm not caring about what happens in September and August. It will be an accumulation period for me, and not just looking to put on some fast swing trades in hopes that the markets just continuously push new all-time highs. Moving into Google right now. So Google is actually up for a good majority of the day, but they gave it all back into the end of the day, sadly. But we are still above support right now. 194 down to 187 is that range. Pay attention to the lows of Friday. If you break those without new highs, you are heading into a daily downtrend, loss of support, and into weekly consolidation. You can clearly see from these candle patterns, they're struggling right here. So it remains to be seen. Will we revisit lower? Anything above 164, though, would be looking for a higher low for possible further trend continuation, and down into 180 is where I would be looking for any leap call options for 2027 or for some more shares for Google. As of right now, I'm holding back. Any big red days, I'll gladly sell some puts down there as well. We covered the earnings very strong, but we do have the Department of Justice ruling coming up in a few short weeks. On to Meta right now. Meta down 1.66% on the day. Not the best day for Meta, unable to go over and above their earnings highs, essentially. So in the event we unwind and close below the low of last Friday, daily downtrend is in order for Meta, and possibly a bit of weekly consolidation after that gorgeous earnings release. Maybe the bulls just don't have it in the tank, but you can blame the SPY and the QQQ and the overall sentiment for that. Definitely cannot blame Meta's earnings. That being said, anything above 694, looking for a weekly higher low for possible further trend continuation. If we see Meta pull back into the low 700s, I will be adding a few more shares to my long-term portfolio as their earnings were fantastic, and I love the growth prospects of this business over the next 2 years. On to Microsoft right now. Microsoft, same concept. Look at these weekly candles. I know we're only Tuesday, and there's a lot of trading to be had, but if you break the low of Friday, guys, clear first daily downtrend. If you also lose this 12 EMA, that's the first time you'll have those two things combined, the daily downtrend and the loss of the 12 EMA. That will be synonymous with weekly consolidation. First touch will probably be the 12 EMA on the weekly, because we don't really have any support levels, guys. They didn't even bother setting any in terms of the weekly time frame, right? So you could unwind this one right now. I'd pay attention to the EMAs. As of right now, the bulls still do control things. We haven't lost it just yet. A lot of trading left to be had this week, but we are overbought conditions. So I'm sure none of you would be surprised if Microsoft chooses to consolidate a little bit after how many weeks of rallies in a row? What is this? Like, let me just measure it right now. 15 weeks in a row? Might be about that time, right? Moving on to Netflix right now. Netflix, the poster child for what happens when you set a daily downtrend and lose 3 months worth of a daily EMA. Well, it's the bears' turn. The bulls had their turn. It was a very good last quarter for Netflix. Now you unwind, right? Rejecting from resistance again, 1216 to 1185. We were calling it out that it was probably going to result in a flush. The flush has now happened, and now you are embarking on week number 6 of consolidation. Nothing wrong with the business, but as I said, guys, eventually this stuff has to normalize, right? So weekly consolidation is underway, and at the same time, monthly consolidation is underway. Look at this July candle close. If that doesn't indicate that there's a lot of selling pressure and that we could go lower, I don't know what does anymore, right? Next stop, 1,065 down to about $1,000. I will be a fan of adding to Netflix shares in around the monthly 12 EMA. No short-term swing trades for me right now, but I will be a fan of adding down there where the valuation is a bit more manageable than where it is right now. On to NVIDIA. NVIDIA down 0.97% and an extra 0.73 in the after hours because of AMD. Still riding a bit of daily overbought conditions right now. Pay attention, guys, to this guy right here. Friday's low, 171. If you lose this and lose the 12 EMA, similar to Microsoft, first time it's going to happen in 3 months. That needs to be notable to you. If that does happen, it's synonymous with weekly consolidation on this stock. So keep that in mind. First stop is going to be 159, 12 EMA. Below, though, we have a ton of support in the event that NVIDIA unravels quickly, which would be surprising, but stranger things have happened, right? You'd be looking for a backtest here of the 150 level. This is where I'll be looking to sell some put options and to further position in the event that markets give me that opportunity. I definitely will be taking it, but the bulls still looking, the bulls on NVIDIA, guys, they're in control, right? But everybody's expecting this. So I'm giving you guys what's going to happen if we don't get that and we roll over, just so you guys don't panic and you know what to expect. Moving on to Tesla right now. Tesla down 0.17%, but Tesla's just been doing nothing, guys. The clearest time frame on Tesla for me is the weekly. This is just a weekly tightening range. It's getting tight. One of two things is going to happen. We're either going to break the lows here, 290, weekly downtrend into further monthly consolidation, or the bulls are going to muster together a bit of a rally, not too sure with what catalyst, but remains to be seen, right? And go into resistance. Resistance is 340 up to 360. No swing trades for me in terms of short-term swing trades, but if you're a short-term bull, then you may not have the catalyst that you're looking for in terms of short-term expansion. The long-term catalyst, obviously, I don't need to go over. We covered that during earnings. But all of you guys that are long-term investors, you're looking for the next 3 to 5 years. So anyways, this short-term price action should not concern you, but kind of trendless right now on Tesla. Very tough to determine which way it's going to break. It'll probably move in the same direction as the overall markets. Moving on to Palantir right now. Palantir up 7.85% after their earnings. A bit of a shooting star candle right now on the chart. Daily uptrend is clear as day. Any move lower, looking for a higher low. Anything above 150, looking for that higher low for possible further trend continuation. But if it ends up like Microsoft or Netflix, right, pay attention. If you get the daily downtrend, that will be the first sign that weekly consolidation is looking to be underway. Anything above 129 on that pullback, looking for a higher low for possible further trend continuation. Palantir had fantastic earnings. We literally covered them just yesterday, but Palantir, similar to other things, I know it's a cult. I know the fundamentals are very good, guys, but still, right, if the markets go into big consolidation, or rather choppiness for the next few weeks, well, Palantir might just not be immune to that either. On to SoFi right now. SoFi down 1.24%. The bulls are trying, guys. It is a battle and a half here at the recent highs. Resistance is 24.5, down about 22.5. Those are the highs from 2021. And in the event that SoFi follows the direction of the overall markets on the breakdown, pay attention to these lows. They're all at the same place. 20.5. You break that, you're going for the daily downtrend. You are losing this 12 EMA officially, and that will be synonymous with weekly consolidation. Weekly consolidation is not a bad thing on SoFi. I will be looking to reposition short puts under the market, and in the event you are in the market for shopping for leaps, well, they should be dated 2027 on any pullbacks. I've been very vocal that it was a great time after earnings to close some of your leap contracts that you may had, which would have been good for August, September, November of this year. Because if you go through choppiness, right, the calls are just going to bleed out, guys. You know what I mean? I know you guys must be up a tremendous amount of money, but taking profits never hurt anybody, or even rolling them to a further date. On to Uber right now. Uber up 1.09%, but that doesn't matter. They have earnings tomorrow morning. So we'll see what happens. Uber is going to move probably 7% either way. 7% higher gets you right back to the all-time highs. 7% lower, unfortunately, gets you back to the big support range. And that would just be a continuation of the daily downtrend, a continuation of weekly consolidation, and would bring you right back to where we first broke this area, right? The whole 81 down to 78 range. Good support, prior all-time high resistance. Now going to be current support with some of the weekly moving averages sitting there as well. And in the lower 80s, the valuation is good. I will cover their earnings for you tomorrow, but short-term price action for earnings, very difficult to predict. And now lastly, TSM, 2.73% to the downside. I was telling you guys, pay attention to Friday, right? These candles, 231, 232, these are the areas that you cannot lose. They're losing them in the after hours right now. If tomorrow is red, it will officially be the daily downtrend on TSM, something that has not happened with the loss of the 12 EMA in the last 3 months. So please keep that in front and center in your mind. And it would just be looking for a weekly higher low. Anything above 206, beautiful, beautiful, beautiful weekly uptrend right here. But as with everything, sometimes things just need to consolidate a little bit. The area of confluence next comes at 220, which is this prior all-time high, not a very strong level, the weekly 12 EMA. The strongest level would be 210 down to 200. That would be a top to bottom decline on TSM of about 13-14%. It can happen, guys. If the Qs go down 5, 6, 7, 8%, then TSM is going to come down to the mountain. But I will be selling put options down here. This is also an area I'm targeting for swing trades, but also for leap call options. Not a bad area to consider. No short-term swing trades from me at this level. If it just runs away without me, I'm fine with that. But there are many other stocks in the market that are consolidating in a decent fashion that I can position into instead. And with that, that wraps up our big tech list and the overall market rundown. Now let's dive into some of the biggest gainers and losers of the day. And let's start it off. You know what? Let's start it off with the biggest losers of the day, of course, right? So let's go into the day today. So Vertex Pharmaceuticals. You guys don't hear me talk about this company a lot because I don't usually trade pharmaceutical companies. Very strong company, guys, but I am not positioning this as a big engulfing move after earnings. We have to wait for it to normalize. Let them show you where the bottom is. We've just cracked support. It looks like FICO a little bit, right? Cracking support, and it's a big level, guys. That's the last, like, what, year and a half worth of pricing. Maybe back down here, if you ask me where I would not mind positioning on Vertex, ooh, that's tough. But if we come down to lower 300s, there may be an opportunity. Not my first bet, and I don't trade pharma that much. Talking about HIMS right now, HIMS was down after their earnings. HIMS as well, right? This is a good company that you can write short puts on. HIMS was all over the place today. They recovered all of the earnings drop in the early hours of the session and then gave it all back again. Huge intraday swing on HIMS. We covered their earnings yesterday. Make sure you watch that earnings result yesterday. We were saying that at $55, it was an okay valuation, but same concept for HIMS. Any buys made here, you should probably take a short-term swing trade out of the question. Any buys here should be done with a longer-term thesis. The longer-term thesis does stand, but HIMS being a growth stock, a very volatile one at that, if the markets do consolidate, you will see a further slide in pricing. If you ask me where I would be interested in positioning, you're not going to like the answer, guys, right? But my answer, once again, is, as I've always been saying, low 40s, right? I'm not saying it's going to get there. I'm just saying if it does get there, I'm maybe looking to add some shares back to the portfolio. I bought in here. I sold up here. Rather, I sold pretty much, 57, 58, which was just before the pre-earnings rally. Come back down to 40, I may add a little bit more, but as of right now, no position, even though we are coming into support. Moving into Figma right now, down another 10%. I mean, I was saying that this was going to happen, guys. It was just way too overvalued. I know some of you guys don't want to hear that because you're used to stocks like Palantir and Robinhood, but still, right? IPO, everybody got trapped. Everybody got trapped, guys. The fair value of this company, you could probably put it anywhere between about $40 and $60, depending on your valuation metrics. But suffice to say, this is another good stock that we can play some short puts on, right? Playing short puts with some really good distance. They just added some strikes to the mix today. $60 and even $50 into August 15th, not that bad. I'm not saying it's going to go there. It doesn't have to. I'm just saying if it does go down there, I wouldn't mind playing it down there. But as a result, we have an order type for that, right? If you're not too sure if something's going to get somewhere, but you wouldn't mind owning it, but in the process of it maybe or not going there, you want to get paid, well, that's what short puts are for, right? So the 50 strikes right now, oh, sadly, the 50 strikes right now are about 40 cents. 40 cents for next week. That's almost 1% with a huge amount of distance. Even the 55s or the 60s are not too bad. This is how I'm playing this one. It's how I played Circle a number of times before. Even when Circle drops like this, guys, same concept. Circle, you don't need to guess the bottom. If you are wanting to buy it, let's say down here at the 120, 110 range, you can go in with some short put orders and stop guessing, right? If you want that price, well, you may as well try and get paid for that price. Take a look at next week's options. You will see that around the 110 mark, you can find exactly 0.5%. I know it's not the most amount of premium, but that is my benchmark minimum for options overall for selling puts in the market. 110 up to about 120, that's the range, and you have a huge margin of safety, a huge margin of safety. Look at this. 22 to what? 30% drop by next week. Those are the types of margins of safety that I want. I've been doing this the whole time on Circle. I've been doing this the whole time on CoreWeave as well throughout this drop. And now maybe we're going to start doing it on Figma as well. So there's just a few of the stocks I wanted to run down. Sentinel-1, guys. Sentinel-1 is coming into the accumulation zone again. So maybe not for some short-term swings, but accumulating some shares or some maybe leap call options because they're cheap. Not too bad between 17 and 14, 15. They just acquired a business today, and as a result, the stock went down. But the fundamentals are not too bad. And it is one of the more cheap players in the cybersecurity landscape, not meaning like their share price is cheap. I mean the valuation in relation to like a CrowdStrike, a Palo Alto, and it's not as big of a company. However, it could be a buyout candidate for some of those other companies. As we've seen recently, Palo Alto is going shopping for some companies out there. Maybe this one might be an acquisition target, so please keep that in mind. Coinbase continues to unravel after their unfavorable earnings right here. We're coming into some of the support ranges, right? 310 out of 290. We're almost through this one. The next big one is at the 200-day EMA, 270 down to 280. Not a big fan of playing Coinbase, guys. Their earnings profile is very, very choppy. The revenues move with the flows of crypto, and crypto, let's be honest, roughly since January, February, March, the crypto flows have not been that good. It's largely been the Bitcoin show and not much of anything else. The altcoins have been kind of left to the side, and trading volumes are just not what they were. It had a tremendous pop during the whole Circle IPO and stuff like that, but now we're seeing a big unwind. It's just not my favorite company. If you're going to play this for stable coins, I'd rather play Circle as a direct play, especially using short puts. Just not my favorite play overall. I know some of you like it out there, but this one, it's just beholden to its own earnings profile. Not my favorite one. Elf Beauty could be an interesting accumulation zone again. Down below here, low 100s down to about 90. They have earnings on Wednesday. So I'll be bringing those earnings to you guys on the Wednesday session. If it does come down there after earnings, I will be buying more shares, but also for some bleep call options. Not a bad fallback area, guys. Just healthy consolidation. Gorgeous monthly move here by the bulls, looking for a higher low for possible continuation, but it's a long duration trade and not a short duration trade overall. Those are just a few of the ones that I wanted to go over real quick. Chewy for me, unfortunately, we're breaking down below 39 to about 35. The next closest area for us on the monthly time frame, which is the clearest time frame in my opinion. I mean, the analyst price targets on Chewy are quite bullish. The market is just not favoring consumer cyclical right now, or consumer discretionary rather. 32 down to 30 is where I might add some positions on Chewy. Very small position for me right now. I'm playing it with short puts. We got assigned here at about 37. I'm running covered calls against it, but there would be a DCA trade down there. Currently daily oversold condition, so we'll look for this one to kind of find its local bottom soon. And a lot of the other ones, guys, like AppLovin, they have earnings tomorrow, so we can't really talk about them too much. NVO, they have earnings tomorrow. Toast just had their earnings. Maybe I'll recap them for you guys. They're basically unchanged in the after hours for earnings. Maybe coming down here, mid 40s for a bit of a retest trade. Wouldn't be the worst trade profile in the world, just a breakout, maybe retest and possibly run. Wouldn't be the worst thing in the world, but I'm just looking to sell puts on it for now. No long positions, no long directional trades for me. The other ones, we've kind of went over them already. In terms of the upside, Symbotic has earnings tomorrow. I'm not looking to position into Symbotic earnings. Oklo and the nuclear plays once again smashing into the upside, bucking the trend right now, but be careful about these ones, guys. The valuation is through the roof. None of these companies make any money for the next 2-3 years, so just be careful. If you're playing these, just wait for the pullbacks into support areas. You play the pullback back down here in a 76, very easy to set a stop loss below this guy, and the next profit target should be something psychological like 100. So just make sure you're getting good risk to reward and not chasing these trades too much. They do the breakout retest of the levels all the time, right? This was the previous high. They back tested it. Easy when you're buying these back test areas to put a stop below there with then a psychological take profit, 85, 90, 95 round numbers, stuff like that. Because let's be honest, we can't do an exit price with valuation because there is no valuation, right? Rocket Mortgage continues to be one of my favorite names. Thematic plays into 2026 and 2027 as the housing market gets the benefit of lower interest rates. Housing market has been very dead recently. Next target for SoFi. Next target for Rocket Mortgage has to be $20. You might know that I have some call options from down here. If you are looking to accumulate this position, it's a question of if you feel that you're late. There's still a lot of meat left on this trade in my opinion, but if you feel like you're late, well, maybe if you have, I don't know, $5,000 to allocate to Rocket, maybe you do half of it now, and on any weekly consolidation, maybe back to the whole 15-14 range on any market consolidation, maybe you start accumulating the rest of the position. No short-term swing trades from me. Momentum is good. Longer-term trades might be very applicable right now too. And that's pretty much the only ones that I wanted to cover. I mean, we can talk about UNH. UNH 4%. They had their earnings last week off of a rumor that Warren Buffett might be acquiring 10% of the company. Who knows? It's an unconfirmed rumor. You guys know the drill with UNH, right? UNH is a very cheap company. I would not be surprised if many of you holding the stock do end up making money at some point, maybe late 2026 or 2027. Talking about all the guys that got trapped here, right? Because if you bought these lows, well, you're already making money, but a lot of people got trapped here. Maybe by 2026 and into 2027, you may make it back. But I'll remind you, UNH is facing a bunch of things they cannot control. They cannot control rising medical costs. They can adjust their premiums, but the premiums for this year are locked in. They'll have to redo the insurance contracts next year. That they cannot control. And the amount of people that have been filing claims with them is also on the rise. They can't do anything against that either, right? So UNH, sadly right now, a lot of things that are plaguing the company are out of their control. Special shout out to MP Materials, still very strong. There are some thematic plays to be had here, such as quadruple U. This one might just be the next runner. Trump administration is looking to fund some of these companies. Well, the Department of Defense, right, is possibly looking for the next company to fund in terms of critical minerals. UUU has been making its rounds on social media. There could be an opportunity for some rallies. Just only put in what you are willing to lose, guys. It's a bit late on this one. And then we also have the other one, which is this one right here, right? USAR. USAR, also a thematic play in relation to critical minerals. Could be a bid, guys, but once again, they could go either way, right? You're not too sure which of these companies is going to get the contract. So keep that in mind, right? Just put in the money that you're willing to lose, but very decent thematic plays to be had overall in that little niche of the market right now. So that's kind of everything I had for you guys today. No more than that. Hopefully you guys enjoyed. If you did, consider dropping a like on today's video. Would really appreciate that for the growth of the channel. Consider subscribing if you're new as well. Would love to have you back. We do these every Monday to Friday after the close and recap the day's events. And in the event that you have any questions for me, please leave them down below. I'll be answering every single question tonight in the comments section. So looking forward to hearing from you guys as well. In the event as well that you wanted to join a trading and investing community, guys, where you can chat with other members and you can chat with myself directly about all of your plays, stocks, options, and otherwise, well, the link to the Discord and our trading community is down below in the video description. Of course, in the trading community, you get access to a few different things. Number one, you get access to all of my trades, whether those are the wheel trades, the directional trades, the lottery trades, the leap call contracts, and everything in between, guys. Those are just a few of the trades over the last few months. The green little check marks are wins. The red little circles are losses. So we've been having a very consistent run so far. Not too bad at all. You get access to all those trades, of course. You also get access to our private morning live streams Monday through Friday, where I stream for about 2-3 hours at the open, trade live, but also take all your questions on your stocks, your options, your long-term portfolios. You can also watch them after if you can't be there. They are recorded. You can also ask me all your questions in our chat rooms throughout the day. I'm very fast to answer. You get access to our private educational section as well, where I go over many different option strategies on different types of spreads, leap contracts, all different types of option strategies, technical analysis, fundamental analysis, how to grow portfolios, whether small, medium, large, which trading strategies should be placed into which account, and how much as well, just best practice there. And a whole bunch of other educational videos that our members find good value in. And lastly, you get access to all of my charts, essentially. So all the charts that you see right now, you can copy paste every single chart. You will get the same support and resistance boxes as me, the same chart layout. It's just an added benefit, right? And whenever I do fundamental analysis on a company, that all comes copy pasted on the chart for you as well. So, you just allow me to do all the work for you and you just basically get my levels, essentially. Just an added benefit. And so much more if ever you guys are interested. As I said, the link is down below. Hopefully I get to see you guys in there soon. And if not, I'll see you right back here on the channel. Take care. That's it for me. See you guys tomorrow. Peace.